G'day everyone, welcome to this weekend update of the global action, and it was another week of the same. America up, Australia, well, we made a slight gain but really struggling, and commodities of course continued to be under significant pressure, and US dollar up, so not a lot of change. The trends are continuing and they look to be fairly stable. So let's have a look at the action for last week. American stocks gained another 8 points on the week. It was 4 the week before, so the rate of ascent is slowing a little bit, but there's still no real sign of weakness. There's no sign that this American market is rolling over, despite the fact that a lot of people are saying that it has to. We're now into the seasonally strongest couple of weeks of the year as fund managers really try and dress things up so that their bonuses look terrific. So you'd have to think that, unless we just get a couple of short-term days down, that we could see this rally go all the way through to the new year. So America is where the global funds are focused. If you're a European fund manager or a Japanese fund manager and you're looking at opportunities in your market and the currencies and all those sort of things, there's really a lot of attraction to be in America. So that's why the American dollar is going up. It's why the stock market is going up, and it is supported by the fundamentals. So I would see no real change to the fundamentals through and to the trends through 2015. I believe that the market is not overvalued, and the growth of earnings in certainly the sectors that we're focused on, as members would know, are extremely robust. We've seen some just outstanding guidance upgrades just in the last week on the stocks that we've been trading and investing in. So it really has been a terrific period, and I don't see any reason why that won't continue. Now, the German Daxx managed to score a new all-time high. Yes, there is better value. The PE ratios are lower in Germany than they are in the US. But in the US, the economy looks good and corporate balance sheets look terrific, and there doesn't seem to be a lot of risk. Whereas, yes, there's better value in Germany, but the risks to me, there's a lot of uncertainties, and that, of course, creates risks. And it's not impossible that we're going to get some financial instability in Europe. So even though there's better value in Germany, I think America is still a place to be. In Europe, it's a rally being driven by stimulus, not one built on fundamentals. The same in Japan, whereas in America, the rally is really driven by very good fundamentals and value. Now, the FTSE didn't do much, finished flat on the week. There's obviously not as much stimulus happening over there, and that's just the way that it sits at the moment. The Aussie market gained 22 points. However, all of 2014 gains have been lost, so the market is basically where it was on the 1st of January this year. So that's a pretty uninspiring performance at the index level. And if you take away the 4 Australian banks, the Australian ASX 200 would just be in dire trouble, because it's only been the banks that have managed to hold it at that level. Now, we've just experienced one of the most volatile weeks of the year. We had the market got absolutely smashed the Friday before last and then on Monday, and then managed to recover through the rest of the week, and then game started back on Friday. So extreme volatility makes the job even harder when stock prices are really not trending. So my strong advice would be that you should be avoiding at least 98% of the local market, and especially commodity stocks. Let's have a look at some charts. We'll start with the S&P 500. So you can see that there is a little bit of a slowing at the moment at the top. It's just starting to go a little bit more sideways than anything else. It is technically overbought. As you can see, the RSI has been up above 70. But really, the ranges are pretty small. There's no sign of any real rolling over at this stage. So you've still got to be pretty confident in what's happening in the American market. Let's look at the NASDAQ index. Similar pattern, and certainly the NASDAQ leads. So if the market was going to weaken off, then you'd see the NASDAQ rolling over first. So that's the American market. Let's have a look at the Daxx. So we had a bit of disappointment on Thursday. So you can see a bit of downside on Thursday when the ECB didn't come out with a stimulus program as the market was hoping. But then that abruptly turned around on Friday night and finished very strongly indeed. FTSE just flat over the last couple of weeks. Let's turn to the Australian ASX 200. And if we expand that right out, and we go through and we find the 1st of January. So it's about here. That's it. So you can see that was where we were at on the 1st of January, and you can see that's where we've pretty much finished the year at the same level. And there's really been no trend in the ASX 200. Really, the end of the trend occurred in September. Since then, it's been downhill since that time. So not looking particularly pretty in the Australian market. Turning to commodities now, gold going $22 for the week, but that was after it was smacked hard the week before. So we're still hovering around this $1,200 mark. As you'll see from the chart, we've had a minor break of support, but we've failed to break back into the main range. It's had a couple of goes at it, but it just can't seem to gain any traction. Now, the US dollar strength is almost certainly going to continue, although the US dollar is at a triple top. We'll have a look at that chart as well. So we might get a bit of a short-term pullback in the US dollar, but you'd have to say that the fundamentals would support the dollar continuing to rise. Now, if gold does break down, we've got major support at 10.25. Let's just leave it at that for the time being and hope that it doesn't go any lower. Gold stock indices have rallied back to the breakdown, just the same as gold has, but have turned back down again. So they're looking weaker than gold. So the outlook is not particularly pretty. And that's why I say just really avoid commodity stocks at the moment. Now, copper recovered slightly to $2.95, but it's still just basically hanging on by its absolute fingernails to that big picture wedge pattern. It has broken support. West Texas Intermediate crude fell apart last week, down to $66 on the OPEC decision, and has basically stayed there and is looking pretty weak. And if you look at the chart of a lot of the US energy services companies, so the companies, the drillers and other service companies, they've been absolutely smashed. So very, very bad signs for the energy sector in America. And as I said last week, the OPEC decision is going to have a very significant impact until at least mid-2015. That's the next time they meet. And a few people have kind of complained about the OPEC decision and said, well, why didn't they reduce their production? Well, that's just crazy, because all the increase in production has come out of America. So what's OPEC supposed to do? Reduce their production while America keeps theirs high to support the price that's making it viable for America to produce so much oil. I mean, that's just commercially crazy. So there was no other decision for OPEC to make, and I don't see them changing that decision anytime soon until they force the American producers to cut back. So if you're looking for a trade in energy stocks, then I think you're going to be disappointed that there's going to be a snapback rally, because it's pretty hard to see the fundamentals changing anytime in the next 6 months. There's the spot copper chart. So you can see clearly in downtrend now since the middle of the year. But before we move any further, let's just have a look at a couple of other charts. There's the gold chart on a weekly basis. You can see we had a really good wedge pattern. We've broken that support. It's rallied back to it, and it's still just hanging on there. Down here is the next major support level at 10.25. So unless gold can scramble back up into this range, get up above maybe 225, 230, then it's not a pretty outlook for gold at the moment. Silver similarly has also broken key support and has not managed to rally back to that breakdown level. So silver is pretty weak also. Let's look at the gold mining index. GDX index also broken support. Key support here at just over $20, rallied back to it, and now has fallen away to a greater extent than gold. So you just can't have any confidence in commodity stocks at the moment at all. So overall, just to wrap it up from an overall strategy point of view, as I said last week, the currency trends make exposure to US stocks an absolute no-brainer. If you're not in America, and you haven't been in America for for most of this year, then you've been missing out big time, and you're going to continue to miss out. Not only are US stocks providing terrific gains in US dollars, but we're getting a big currency boost as well. And as members of Special Share Education know, we've had a substantial boost from the currency dropping from the mid-90s down to the low 80s. So it's in Australian dollar terms, the gains have been terrific. So my advice would be to avoid most of Australia unless you're shorting. The stocks that are trending are extremely overvalued in my view. They're not value either fundamentally or technically, even though they're great stocks. So it's tough to make money in Australia at the moment. And I would avoid commodity stocks, and especially resource service companies, mining service companies, energy sector service companies, because this is not a cyclical situation that's going to turn around in 6 or 12 months. This is structural. We could see this scenario take 5 years, 10 years to rectify itself. So I'm not saying you should avoid commodity stocks for that whole period of time, because inevitably markets get overvalued and they do present some basic good rally opportunities. But in terms of an extended and protracted commodities rally, it's hard to see how it's going to happen. So that's the wrap up for this week. If anyone would like, obviously who's not a member, who would like more information about what we do, particularly what we're doing in America, which has been, really outstanding, then that's my email address. Please feel free to get in touch with me. That's it for this week. Cheers.